Folks, one of the ways to take advantage of this current coronavirus environment or any market where it's hard to predict direction is by using pairs. Now, what is pairs trading? Let me give you some background. Let me give you the nukes and crannies and give you a good outline. And then in the next few videos, I'll show you a few examples and I'll give you some actual how-tos, but this will give you a good overview. So during the 80s, a group of quants is traders who are quantitative, who use quantitative math and analysis. They're called quants for short. I'm a quant. I use algorithm trades. Anything that doesn't use fundamental analysis, that uses numbers and data and crunches data to find out statistics, that's what a quant is. So a group of quants in the 80s working for Morgan Stanley, they struck gold with a strategy called the pairs trade. Institutional investors and proprietary trading desks at major investment firms have been using this technique ever since. And many have made a tidy profit with this strategy. It's rarely in the best interest of investment bankers and mutual fund managers to share profitable trading strategies with the public. So the pairs trade remained a secret of the pros, so to speak, and a few deft individuals until the advent of the internet. Online trading opened the lid on real-time financial information and gave the novice access to all types of investment strategies. It didn't take long for the pairs trade to attract individual investors and small-time traders looking to hedge their risk exposure to the movement of the broader market. Pairs trading has the potential to achieve profits through a simple and relatively low-risk positions. The pairs trade is market neutral, meaning the direction of the overall market does not affect its win or loss, which is really important, especially right now. The goal is to match two trading vehicles that are highly correlated, trading one long and the other short. It's that simple. Two trading vehicles that are comparable, one long, one short, making sure both positions have an equal as possible dollar exposure in the markets. That's actually the biggest challenge of the pairs trade, making sure exposure on both positions is relatively equal to the other side. The process of selecting the trade would go something like this. First, we pick two assets that are highly correlated to each other. For example, the S&P 500 versus the NASDAQ 100. How about Ford versus GM? How about Intel versus AMD? How about gold versus silver or euro versus the dollar? There's many different ways to select the two assets. The key is to make sure that both assets are in the same industry, in the same sector, and highly correlated. You can use Coke and Pepsi. You can use Norwegian cruise lines versus, what's the other cruise ship called? I forgot the name. Carnival versus Carnival. You can use American Airlines versus Delta. The point is to find two stocks or any other assets that are highly correlated. Now, one way is to use my CSI, my patented CSI scan, which constantly scans the markets for the strongest and weakest stocks. You can even search individual sectors to see which stocks in the same industry is leading and which one is lagging. You can then buy the strongest and sell the weakest stock. Regardless of how you choose the two assets, you've got to make sure their exposure is extremely compatible. In other words, you need to make sure each position has similar dollar exposure to your other position. Otherwise, you're not truly neutral, which is the goal of the pairs strategy. The way I like to make sure the positions are equal is to use a 10-day ATR indicator and to measure the dollar range for each share. This allows me to equalize exposure between positions as closely as possible. So for example, if stock A has a 10-day volatility of $5, while stock B has a 10-day volatility of $2.50, I would simply buy twice as much of stock B in comparison to stock A. Similarly, if stock A has a 10-day ATR or volatility of $10 and stock B has an ATR volatility of $15, you would buy 1.5 times as much stock A in comparison to stock B to give you the proper exposure between the two stocks. If you trade options instead of stocks, I highly recommend you perform volatility analysis on the actual stock instead of the options, since options demonstrate too much movement and don't give accurate volatility measures in comparison to the actual stock. Once you know the difference in the shares, in the volatility of the shares, you can then create an option position based on the share size. Now, the best way to get involved with pairs trading is to execute a few pairs trades, maybe even on paper, till you get a feel for the strategy. What I find interesting about pairs trading is the different ways traders identify the strong versus weak stock. Some use relative strength filters, while others use technical indicators, and some use fundamental price data and long-term monthly charts. And that's what I like about pairs trading. There's enough moving parts to keep things interesting, but at the same time, trader has the opportunity to match the assets and the position size as well. Typically, because there's two sides to the trade and there's a strong correlation between them, the risk is relatively smaller in comparison to net speculative trading. Now, this offers beginners a way to enter the market with lower risk and higher expectation of profit over time. All in all, I highly recommend pairs trading, and over the next few weeks, as I mentioned, I'll do some videos showing you how I determine the two assets and how I determine the position size, the two biggest hurdles to profitable pairs trading. Talk soon, hope that helps.